Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and boy, oh boy, welcome to the third quarter of 2022. And boy, has it been a vicious 6 months for stocks. This has been the worst start to a year for stocks in more than half a century, just to put it in a little perspective. A record-setting run fueled by cheap money has now officially ended, and Wall Street is having a hard time adjusting to a new reality. With the Federal Reserve aggressively hiking interest rates to fight high inflation, the economic landscape has changed dramatically, and most of us can feel it. At the halfway point of the year, the tech-heavy NASDAQ has fallen by more than 30%, and the broad-based S&P is down by over 20%. Both indexes are now officially in bear market territory, and the Dow Jones Industrial Average is in correction. Year to date, it's down over 15%. What we know is when interest rates go up, it changes all the math from buying a house to a car to buying bonds or even tech stocks whose earnings are typically far off in the future. We've also seen massive swings of 1,000 points or more on Wall Street, which reflects the high level of nervousness among investors. Many are worried the Federal Reserve will tip the U.S. economy into a recession. And while the volatility has been mostly driven by rising interest rates and inflation, there's no shortage of additional geopolitical risks. COVID-19 continues to wreak havoc, and lockdowns in China, global supply chains remain clogged, and Russia's invasion of Ukraine continues. We know historically when interest rates rise and borrowing costs go up, investors typically pull out from the riskier parts of the economy. High growth companies and tech stocks are the first to see their stocks fall. This time is absolutely no different. The S&P 500's worst stock performer to date is Netflix, which is down over 70%. It's an incredible reversal for a company that saw its share price skyrocket during the pandemic when the streaming service became a lifeline for the locked down. The second worst performer is Etsy, the online marketplace for art and craft from artisans, is down almost 65%. You can also count on some areas to do well when just about everything else is tanking. In this case, Russia's invasion of Ukraine drove oil and natural gas prices higher, and gasoline and diesel prices are at record highs. This rise in commodities prices has benefited the global energy giants, many taking in record profits. So far, the best performer on the S&P 500 this year has been Occidental Petroleum, which has almost doubled in price. Valero Energy returned around 40%, and ExxonMobil, Hess, and Halliburton are also big winners. Here's what we know. On January 5th, notes from a Fed meeting that took place at the end of 2021 were released, showing how Fed members saw rising inflation as a major risk to the economy and how they would have to start raising interest rates sooner than expected. Investors typically react very quickly to this kind of news, and the markets took notice, with all major market indexes falling that day, with the NASDAQ being hit the hardest at over 3%. And things just got worse from there. Fed officials continue to affirm their negative stance over the next few weeks and months. The inflation numbers got worse, and that combination sent a spiral of pessimism through all the markets. To combat inflation, which is running at a 40-year high, the Fed has acted aggressively. It's raised the benchmark interest rate 3 times so far this year, including once in June by 0.75 of a percentage point. This is the biggest hike since 1994. This has been a very fast-moving environment where inflation continues to surprise to the upside, and the Fed's own projections of how quickly it was going to raise interest rate kept surpassing expectations also. Because the Fed first underestimated inflation, they're now having to play catch up. And both the Fed chair and the Treasury Secretary seemed confident inflation was going to fade, that it would be a short-lived consequence of the US emerging from the darkest days of the pandemic. Now we know that they were both highly underestimating the path of inflation and were They were slow to act in the process of correction. A few weeks ago, Janet Yellen actually admitted she had misread the moment and was quoted saying, "I think I was wrong then about the path that inflation would take," in an interview on CNN. This year's dramatic rate increases are a reflection of the Fed playing catch up, but some fear that it also signals the start of a new era of higher interest rates over a decade of easy money policy. Some believe that it will be necessary to deal with higher inflation going forward as well. The Federal Reserve is administering some tough medicine to the US economy, and policymakers are aware there are risks in doing this. If the Fed's interest rate increases cool the economy too much, it could lead to a deep downturn and even a recession. Even Powell doesn't discount the possibility that there's a risk the Federal Reserve could go too far. There's a huge desire among policymakers and politicians, especially, to see changes immediately. But to everyone's frustration, it will take time to see if the Fed's decisions are actually working. If in a few months there are indications that the Fed is succeeding at bringing inflation under control, markets will start to stabilize. But if it becomes clear the Fed isn't getting a handle on inflation, then all bets are pretty much off. If you do not have your own strategic financial plan in place, then negotiating what to do during these very chaotic times can be very challenging, if not downright impossible. Investors without a strategic plan can make knee-jerk choices about what to do, many times making their situations even worse. So please take advantage of our complimentary discovery session to see what your next step should be. Thanks for joining us, everybody, and I will see you next week on Friday's Focus on Finances.